Welcome to the first and hopefully not the last episode of Making Sense of Sense, where we break down personal finance topics to make you not overwhelmed by all the chatter in the markets and instead can apply these lessons and new ideas to your life in some shape or form. Whether you're watching me on YouTube or chose to listen to my voice here, wherever you are, if you're out there, welcome. Ultimately, my goal with this podcast is to make every episode sound conversational and fun, and as possible to break down the taboo around money and all the opaqueness and vagueness in this world, to make sure you're excited about tackling your financial future and goals. I want to keep things brief here. Time is money after all, and our time is precious. So let's just get started with a rundown on what's going on in the markets lately. I would much rather do that instead of elaborating on myself, but happy to go over my background if interested in following episodes. So if you haven't heard, yesterday on September 21st, 2022, the Fed, who governs monetary policy and whose goal is to achieve the dual mandate to stabilize the economy by keeping unemployment firstly as low as possible, which is currently at a national rate at around 3.67%, near pre-pandemic levels. And its second task is on the agenda to get inflation back to its target at around 2%. Clearly, if you're a consumer or just a human being, you've probably noticed prices are higher than usual compared to last year at about 9.5%. This is a record 41-year high. And the Fed yesterday on September 21st, for the third time this year, hiked interest rates to curb borrowing and spending, and all of this revenge spending that Americans, consumers have been going through for the past 2 years after lockdown. And you may be asking, how are consumer balance sheets so thick and spending so high? Well, since the onset of the pandemic, the Fed pumped trillions into the economy by buying mortgage-backed securities and government bonds to lower interest rates and spur the economy, and ultimately deter it from a recession. While the fiscal side of things, which is dealt with Congress, they sent out PPE loans to small businesses and stimulus checks for those earning under a certain annual income in America to get back on their feet, especially those who may have been laid off during the pandemic due to small business closures, while unemployment was slowly ticking up at that time in 2020. Fast forward a few months since all that pumped up stimulus and massive frothy demand, the market quickly rebounded and hit record highs in no time. And at the end of Q2, beginning of Q3 of 2020, I'm sure you guys remember that. And this caused a very speculative, frothy market for especially equities, public markets in general, alongside the housing market and even private capital markets within private equity and VC. A record number of unicorns went public simply based on their valuations, not even profitable companies, most of them. And they were just chasing a pot of gold at the end of the rainbow. And since all good times must come to an end, clearly the start of 2022, there's been a variety of systematic risks mixed with micro and macro related developments that have led markets to seesaw and encounter definitely turbulent times that we haven't seen before. And that's leading to looming recessionary fears on the horizon into 2023. To mention a few of these indicators, I'll start out with the rampant inflation from all of this revenge spending that's been going on these past 2 years as people have been locked down and built up their cash cushion. There's also been lower inventory on the housing market since all this demand and a housing bubble that's been created for these past 2 years led to record home buying sprees and a really frothy market, leading to higher obscene prices, with homes selling for 20, 30 times their listing price and above market. And alongside this, just the Russia-Ukrainian war which started in late February of this year, which led to an energy shock and crisis across the globe. And that hurt consumers at the pump here in the States, and also supply chain constraints that have been ongoing since 2020, and especially since even mid-pandemic, due to too much reliance on China for protection equipment related to hazmat suits and masks, all that equipment to keep us safe during the pandemic. And last but not least, just the unanticipation for spending for chips, and that are really powering everything from our iPhones to our cars. And of course, the tight, hot labor market that is still resilient, with job openings close to 500,000 each month this year. And it's a really hot, tight labor market. That's one of the main indicators as well. So you may be asking, why is a recession a concern for consumers now? For analysts and economists, well, to slow down this massive spending spree requires higher rate hikes. Currently, this is the third time the Fed has hiked this year. Yesterday, with a 75 basis point or 0.75 percentage point increase in borrowing rates to hopefully slow down the economy and engineer a type of soft landing. And since equities, especially tech-heavy sectors and FANG companies, rely on future expected earnings, as they're pretty cash-strapped companies, they're selling off right now, unable to keep up with costs. And as a result, they're trimming off low-performing workers at the workforce and just slowing hiring across the board, even in the financial sector and big banks as well. And to me, this is pretty shocking and pretty sad at the same time, given that these are Fortune 500 companies, they're defensible, established firms, and they just over-anticipated their growth metrics and didn't realize that the good times don't last forever. And spoiler alert, they don't. Luckily, the housing market is resilient, though, with unemployment at pretty low levels, as mentioned earlier. However, come later into the fall, happy first day of fall, by the way, credit bureaus and retailers will be monitoring delinquency rates and credit card borrowing rates from consumers. This is also an indicator that economists pay attention to make sure that consumers are still on the right track and aren't cash strapped and not pulling back on, and maybe pulling back on spending or not. Another indicator that's really important to keep in mind when evaluating if there's an impending recession or not is the inverted yield curves. Right now, this is arguably the best time to hold on to your cash. And I write about this all the time, how cash is king, and you can really earn a generous yield more than ever before today at around 3 to 4% from some banks and credit bureaus on your savings accounts. And this was also the reason why big bank CEOs testified before Congress yesterday regarding rate hikes and yields on savings accounts. Luckily, once you tap into, let's say, money market funds, CDs, certificates of deposits for short, short-term treasury bills, which now are paying close to 4%, which just hit that yield mark yesterday for the first time since 08-09, the great financial crisis. And even savings bonds are all options to deploy your cash in better ways, which in savings bonds case are all adjusted to inflation, and a great way to deploy that cash. The inverted yield curves, when the short-term treasury bills yield at higher rates than the longer-term treasury bonds, most notable the 10-year, which is also a measure and indicator of the economy and how consumers are faring. And if it inverts, this is typically a precursor to a possible recession. However, as a consumer, you have a lot of control in your hands, especially with 6 to 12 months of living expenses and cash on hand, and being able to invest in short-term treasuries and deploying that cash and making sure that you have at least 5 diversified passive income sources that are non-correlated to one another. You're in pretty good hands alongside just owning any real asset from real estate to artwork to farmland. There are abundance of opportunities. And what's key here is to plan for the worst, hope for the best, as they say. Lastly, I also want to briefly touch on the housing market. Pending home sales and where mortgage rates stand, which are currently slowing down as housing starts and home sales are a major indicator as well. Given the housing market has cooled, this is a great opportunity for cash cushioned potential home buyers to tap into their first potential new home purchase right now, since they're seen as one of the most attractive buyers at this time, given home buying has typically traditionally slowed in the fall months after the summer, and sellers at this time aren't going through a furious bidding speculative war as they did in the past few years. And now the power is really in your hands to snag a deal as a potential home buyer. So these are a couple indicators and factors I'm looking at currently in the economy, not to mention FedEx, a public company giant in the shipping delivery business, that gave a hint to uncertainty on the horizon with its estimates for Q4 results heading into the holiday season, which has made some analysts and economists a bit skeptical about what's coming up for the horizon in terms of shipping and deliveries. However, for now, no matter if the Fed hikes 2 or 3 times or what FedEx or public companies are issuing on their statements, you know what you can control. And having extra cash on hand, diversified passive income sources to stay afloat are essential, and living below your means as well, something that especially students and individuals my age as Gen Z should prioritize. And now, speaking of economic developments and how the economy has really flipped on its head lately, I recently wrote an article on the new hot trendy business of investing in people rather than just plain old business models themselves. So just imagine if you could invest in 18, 19, 20-year-old Elon or Bezos, or even yourself, and earn an appreciable return based on your or their net worth, whoever the individual may be, or on their cash flow. Now, this process is still in the works, and I would suggest you read my article, which is linked and will be linked below through my site, or you can find it anywhere that you search on the topic. And there are various variations you can take with investing in individuals. And surprisingly, this is more common than you think. And I actually believe that it's also more of a diversifiable way than investing in real companies, given that there's a 9 out of 10 chance that businesses will fail, while on the individual front, individuals are more naturally more diversified, and there's at the same time less at stake here. Some of the ways of going about investing in an individual may include taking a sliver or share of every time one's net worth increases or their business venture succeeds. You can possibly get paid royalties every time they earn a lump sum or windfall, or just going with the conventional route of loaning someone money to help them see success down the road in their own ventures. Now, this is not a completely novel concept, yet it's at the same time not that widely known. A group of siblings, as noted in my article in Silicon Valley, have already tried to pioneer and test this idea out, and something that you can even do with yourself as a kind of mental reminder to keep track of your goals. It doesn't have to be through a specific entity or trust as they've made it through. It's just something that everyone should keep in mind of. And whether or not you believe in investing in yourself, hopefully you do, and never give up on yourself, since I certainly believe that the best investment is always in yourself. It pays dividends for a lifetime and offers the highest yield and ROI. So that's it, folks. Thanks for listening to the first and definitely not the last episode of Making Sense of Sense. Hopefully it made sense itself. If you didn't enjoy this episode or are looking for something different, feel free to let us know why. I'm always open to constructive criticism, especially as a college student. make sure to subscribe to Boiled Not Fried, my personal finance blog, to boil down the basics of personal finance and to not get fried. And join Atticus, an investment management platform that my team and I have been working on for a couple years now, and made for young, ambitious young adults and small business owners to build long-term passive wealth in a prudent way. See you next time.